Hey, welcome back to the Mining Pod. On today's show, we're joined by Chris Bendiksen of Coinshares. He is a Bitcoin research lead and he's been working on the Bitcoin mining investment landscape for basically forever at this point in terms of Bitcoin mining years. So we brought him on to talk about a new article he wrote, No End in Sight for the ASIC Arms Race, the ongoing depreciation nightmare of ASIC owners, and why their wake-up time might still be far, far away. He wrote this mid-month, September. Brought him on to talk about it. I'm actually going to read the article. It's not too long, but I think it lays some good groundwork and context for the 25, 30 minutes of conversation that we have ahead. Of course, this is like a sticky issue. Investing in Bitcoin mining is what Bitcoin miners do, yet ASICs continue to be a terrible investment. So how do we square this? He makes a pretty good case for how to think about this. So we are going to dive on in. First, a word from our sponsors, and then a reading of the article, followed by the conversation.
Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com. Thanks for listening to The Mining Pod. Want more? Subscribe to our main feed on Apple, Spotify, YouTube, or wherever else you get your podcasts for another weekly show on Bitcoin stocks. And check out our newsletter at miningpod.blockspace.media today.
Okay, let's jump right into the article. I heard it first around 2018. Over the preceding 3 years, mining difficulty had grown by a factor of 100. The difficulty was still growing rapidly, all into an environment of brutal Bitcoin bear market, and the miners were struggling hard to make positive ROI on their ASICs. Not that things were nearly as bad as in, for example, in 2014. Back then, hash rate was growing so fast, and ASIC might be rendered obsolete in a matter of months. But industry voices assured me, this time ASICs were nearing the limits of Moore's law. There's only so much left to be expected in terms of improvements in mining efficiency. Chip commodification was near at hand. Why is this a problem? Well, Bitcoin miners have a very peculiar cost structure, and one of the dominating factors is a protocol-dependent variable cost function called the difficulty. This function ensures that the Bitcoin emission schedule stays on target regardless of the hash rate, which is great for Bitcoin holders. But it also means that if new, more powerful, and more efficient mining machines are entering the mining network, their mere existence will rapidly depreciate existing, less powerful, and less efficient mining machines, which is a huge ongoing challenge for miners. In short, compared to almost every other industry, miners have a very short window of opportunity to achieve ROI on their mining machines. Miss this window, and the relentlessly increasing difficulty will render your units unprofitable forever, forcing miners to make large write-offs. This is why ASIC commodification is longed for by most miners. Once it arrives, it would not only stabilize the industry, allowing us to bid farewell to the absolute rat race of growth at all costs that's been defining characteristic, but also unlocking new and exotic business models such as solar mining or electric heat using ASICs. All we need is for the technological race to slow down. Those reassuring voices I heard were speaking to me almost 6 years ago. Since then, hash rate has grown another 15x, and the efficiency factor of the leading mining machines has gone from around 100 joules per terahash down to, if we are to believe the specs from the newly announced S21 XP Hydro model from Bitmain, 13 joules per terahash, an eye-watering number and a sevenfold improvement. Back in 2018, I made a scatter plot of efficiency versus release date for all the ASICs I knew of at the time. The trend has tapered somewhat, but looking at the plot, we see nothing like the type of constant diminishing improvement we'd expect if we were approaching some technical limit, making us unable to attain even higher efficiency at the miner level. This means that the rapid depreciation rate of the past continues today, and that the window to attain positive ROI on ASICs remains, even if not quite to the same degree, still very tight. Technically, infinite efficiency improvements are impossible. The reason everyone anticipated the end of Moore's law is simple. Within the bounds of the laws of physics, a circuit can only get so small. Eventually, the width of the wiring is on the order of a few single atoms, and they cannot get any smaller, at least not in this universe. Simultaneously, the denser the circuitry, the more trouble you'll have effectively dissipating the heat generated by their operations. That's another big problem, because if a chip gets too hot, it doesn't properly function. Even if you'd imagine that we've transcended semiconductors and are using the smallest theoretical items that can conceivably carry a binary state, such as the spin of a single electron for computation, those two have a theoretical limit to their density, not to even mention the logistical issues you'd still have with heat dissipation. So the limit is surely there, and it's not hard to realize at some point it must be hit. However, there are a lot of ways to squeeze out more efficiency from ASICs. The major problem is, of course, being able to anticipate when this all will come to pass. And this is where many people's imaginations have been severely lacking. Thus far, the ASICs making up the nanocircuitry of modern mining units have gone from relying on unspecified generalized chips like GPUs or FPGAs to utilizing application-specific chips produced by the latest generation of lithographic chip-making technology in less than a decade. Mining ASICs raced from employing less than 100 nanometer chip technology to 3 nanometer in 10 years, a development that took more than twice that long in the larger microchip industry. Clearly, that trend cannot continue. But it's really important to note here that while the theoretical circuitry density of a chip is one thing, optimal circuit design is another. While Bitcoin ASICs may have made it to the bleeding edge of semiconductor technology, given how young the industry still is, and how small it is compared to even single companies such as Apple, Samsung, NVIDIA, it is hard not to think that there must be plenty of design space improvements still possible in the niche of niches that is SHA-256 ASIC chips. So that's one way. While chips keep getting smaller and denser, manufacturers are coming under heightened pressure to keep performance high and steady under increasing challenging heat dissipation conditions. The answer from manufacturers thus far has been water cooling, including several simple non-mineral based coolants such as antifreeze. This is a simple technique that allows chips to run at higher power without overheating, effectively increasing the efficiency of the chips. That's another way. On top of all this, developments in firmware have enabled fine-tuning of unit fleets, searching for optimal points, if they exist, in the efficiency versus performance graph, both of individual units, all of which are slightly different due to the quality variability in the hundreds of chips inside of each unit and the fleet as a whole. And that's yet another way. The point is, ASIC efficiency can be ground out of a whole number of not yet fully optimized areas of miner manufacturing. And so the idea that commodification is anywhere near or even on the horizon seems about as likely as it was back in 2018. But wait, there's more. On top of that, to almost everyone's dismay, improvements in ASIC manufacturing costs have the same impact on difficulty improvements and efficiency. Even if we do get to a point where improvements in ASIC efficiency sufficiently slow down or even come almost to a complete stop, ASIC owners are still not out of danger. Even if efficiency improvements may grind to a halt, there is no reason to assume that cost improvements in the manufacturing process should do the same. And this is especially true in Bitcoin terms. If prices of ASICs were to keep falling at a similar rate to the efficiency improvements we have observed thus far, the effect on the current owner of ASICs would be exactly the same. It would drive up the difficulty and make the new owners who got the ASICs at a cheaper cost able to tolerate a higher Bitcoin production cost, making it harder or even impossible for the old owners to attain positive ROI on mining machines. For investors, this is a time where we should probably be looking with particular extra interest into the depreciation schedules of the various miners. If the period over which certain batches of miners are depreciated on the company books is longer than the actual real-world period of cash flow positive lifespan of the ASICs at their given levels of electricity cost, this all seems bad for the lot of players in the mining industry, particularly those in the higher end of the cost curve. Read the PubCos. It's not bad for Bitcoin, though. In fact, it barely matters at all. So at least there's that. Hey, welcome back to the Mining Pod. Today we're joined by Chris Bendiksen of Coinshares. You do everything Bitcoin at Coinshares, so we don't have much of a title for you besides Bitcoin guy. You gave me one a second ago, but we'll stick with that one.
That's a good one. It conveys meaning. Bitcoin guy.
It does.
Bitcoin things.
I think it works. Okay, so we brought you on the show to talk about a new piece you just put up on the Coinshares research blog, which we will link in the show notes. No end in sight for the ASIC arms race, the ongoing depreciation nightmare of ASIC owners, and why their wake-up time might still be far, far away. And I love this piece because it actually put in writing what a lot of people who are invested in mining stocks don't want to talk about, that being the underlying asset that Bitcoin miners invest in. You know, the value of it just goes down so much, and it will continue to go down. So we'll go through this piece. There's much to talk about, but I want to start off. Why did you write this? Like, what was the motivation to take shots at the entire mining industry?
Oh, I'm not, not taking shots. I'm just writing.
Educating.
Yeah, I'm just writing what everybody, like you said, it's like what everybody kind of knows, but don't want to talk about it. Just put it in writing. I mean, it's been talked about for many years that mining is kind of like a tragedy of the commons type of thing, and it is. And so it's I just feel like it needed to be put out there. Part of it is sometimes when I write these pieces, it's also to crystallize the ideas in my own head. because you can have a concept kind of like abstractly floating around your brain, but if you actually want to talk about it to people, then it actually helps a lot to write it down. And so, that is an opportunity that I have at work. So I do that, and then it actually brings value to, our readers. So.
Yeah. So like, I think in the Bitcoin mining stack for new listeners, and we are on CoinDesks now, so get some new ears here and there. But Bitcoin mining assets, normally like the energy contracts, the infrastructure itself, from the buildings to switchboards to electrical lines, transformers, and then the ASICs themselves. I guess the last part maybe we can add on there is Bitcoin, depending if Bitcoin miner decides to keep on that hodl. The issue with one of those four, maybe two of those four, if you include Bitcoin, is ASICs just wildly swing over a 5-year time horizon. Typically really expensive at the beginning and then, basically worthless by the end. And Bitcoin miners are constantly in this treadmill of dealing with it. In the beginning of this piece, you talk about how in 2018, there was this idea that, we can't get much better. Like these ASICs can't get much better. But here we are 6 years later. Yikes. 6 years later. And time moving fast. 6 years later. And we're really not at end of sight. Why do you think that? Why do you think we're not at the end of the rope here, or we're at 13 joules per terahash for the top of line Bitmain ASICs?
So like I say in the piece, like already in 2018, I was hearing, because this was a discussion point even back then. It's like, well, okay, mining seems like it's a great business across the board, but there's this big elephant in the room, which is the extremely rapid depreciation of ASICs. And even in 2018, like that depreciation time had come down a bit. I mean, I'm old enough to remember when ASICs were depreciated down to basically zero in terms of net positive cash flow generation within a span of like 6 months back in like 2013, 2014, when things were absolutely wild. And so by 2018, you could at least expect an ASIC to last a few years. I mean, some S9s, the Kalashnikov of mining ASICs are maybe still even out there somewhere. But the idea then was that Moore's mining ASIC producers have kind of piggybacked on previous rapid iterations in the chip manufacturing industry. And so we went from, like 130 nanometers down to, I don't even remember what the S9 was at, but it had improved by like an order of magnitude over like really short time, like much faster than the rest of the silicone industry. And so there was this idea that, we can't possibly like keep up this incremental improvement in ASIC efficiency over time. Like we're going to hit some like end to Moore's law or whatever. And the week before writing this piece, I was like, you know what? Like let me run the numbers again and look at, because I even have the graph from and I have the 2018 graph too in the piece. And that is from one of the first Bitcoin mining reports that we ever wrote. That's the same. It's basically the same data set, more or less. And if you compare the two, I mean, there's not really much appreciable change in the trend line. And that is on a log scale. So this is an exponential decrease that we're looking at. It's flattened a little bit, but it's nowhere near the, Moore's law is like kind of behind us type of thing. Like we're still looking at exponential declines. And if you look at that, there is really nothing in the last like 2 or 3 years that looks anything like that, we're somehow breaking up here. And I needed to put that into words. So I was like, okay, 6 years ago, I heard that argument. It wasn't true then. It doesn't look like it's true now. Like, what does this mean? Has the industry actually taken this on board? And I think the answer to that is no, largely no. And, a lot of remaining parts of the piece is talking a little bit about why is that, and I think there are many reasons, a lot of which are incentives, and a lot of which are just the I didn't mention like tragedy of the commons like in the piece by name, but that is kind of like the same dynamic that we're looking at because the competitiveness is so cutthroat, and no one out there ever looks towards upgrading their fleet of ASICs to a higher hash rate with a better efficiency, and then cranking down the amount of total power that they're using. That is just not a way that people think about this. Mm-hmm. If you have 100 megawatts, you're going to use 100 megawatts. And if you get new, better chips, then you're going to do more hash rate, right?
Yeah.
And that's how everybody thinks. And that's how everybody kind of has to think too. It's the built-in incentive structure of the protocol. And so what happens? Well, difficulty goes up, and then it kind of wipes out over time all the efficiency gains. So there is no such thing as, large-scale efficiency gain in the industry in terms of less power usage. There's only more hash rate. Hash rate go up. The hash must flow. That is just the way it goes.
We're steering dangerously close to turning into a Marty Bench show when we're talking about the difficulty adjustment being the most competitive thing ever invented. And that's a good point to make. I want to go back, though, towards your article and talk about some of the places that we're seeing ASICs becoming more competitive. And you call out basically every single one, whether it be the chip size to immersion tech to firmware. Tell me a little bit about that. Have you been surprised over the last few years seeing some of these different edges being broken off and smoothed over? Or has that been kind of surprising to you?
Yeah, unexpected, I would say, because I'm not that deeply into the nitty-gritty of why these ASICs get better or why they're gonna. I'm a researcher. I look at this kind of from 10,000. I'm an investor too in the mining industry in general, but
yeah,
I look at this from like a 10,000 feet perspective, and so I have definitely been surprised by the improvements that have come from like cheap type of immersion cooling, like hydro. That kind of took me a little bit by surprise. Like I didn't expect that, and also that the kind of capex of that would fall so rapidly. That was a surprise. The firmware is something that a smooth brain like me has over the years probably not fully appreciated until recently. And the firmware gains are substantial and very important. And so the kind of conclusion that I came to is that even if we end up at a point where, okay, yeah, maybe you can't fit any more transistors on like a certain unit area, well, can you add another axis? Can you start like putting some height to it? Can you squeeze out more in terms of better cooling? I mean, additional firmware, all of these things. And at the end of the day, even if all you're getting is the same density of transistors, but for a lower and lower price, that actually has the same exact effect on the market. And so it doesn't even matter if we run into technological kind of walls in terms of the engineering of the chips themselves, so long as the engineering of the production of the chips is actually improving such that is getting cheaper and cheaper. And I don't see any reason to think why that wouldn't happen. Then there's no reason to think that we're looking at any appreciable slowdown here. So if you're taking big bets based on this, on large capital stack tied up in ASICs, then like you really, really need to respect the difficulty increase that comes purely from improvements in efficiency. And I very rarely see that when I look at mining companies from an investment point of view. It is very, very rarely looked at as like a real risk factor to the future of the business. People just think that, oh, Bitcoin price is going to go to a certain level and the difficulty is going to stay the same. And I'm just like, you guys are delusional. This is not going to happen. This never happened. Do not rely on that. Also, you're not getting my money.
In the competitive world of Bitcoin mining, one name stands out: CleanSpark, America's Bitcoin miner. At CleanSpark, efficiency isn't just a goal, it's our standard. Our sophisticated facilities are built and led by expert teams who care about Bitcoin and the communities we work in. Scale? We've mastered it. Our large-scale operations have set us apart in the industry as examples of community-oriented building. Our track record speaks for itself. We navigate the complexities of the new economy with precision and with skill, continuously achieving operational milestones. Curious about how we do it? We invite you to discover the story behind CleanSpark's success at cleanspark.com.
Okay, let's talk about the investor side a little bit, that because it is interesting. It is an interesting game, right? So if we look at any sort of mining company out there that's put in a large purchase order over the course of end of 2023, beginning of 2024, they're basically banking on early access to S21s and S21 series units, getting a jump on hash price by getting those pre-orders early, kind of building up that stack, paying off those ASICs. The dollar per terahash on them is low historically compared to a last bull market, or at least similar timeline in Bitcoin price. And so I think the argument for a lot of these PubCos and certainly some private companies who have access to these future orders is I can make my margin by being ahead of the pack. And then over time, yes, these units are going to depreciate, but I can take advantage of the taxes on that and kind of write those assets off and kind of help my underlying tax statement. So it does seem to be like a game that some people are playing well. Mm-hmm. From an investor standpoint, do you see that when you're looking at investments, or is that still just like too much of a hot potato to be worth touching?
I mean, that's one out of two main edges that you can have in the industry. One of them is low power cost, right? And then the other main edge that you can have is preferential early access to these things. Yeah. And why is that important? Well, because difficulty always go up because the ASICs are getting better and better. And so if you look at it from a market-wide point of view, for the market as a whole, there's no such thing as early preferential access, because the market as a whole is the average of everyone. And so, maybe you got early access to this batch of like S21s, but then when the next batch of the next cool thing comes out, you don't have the capital to go and get preferential access to that. And then the nominal size of the hash rate increase and the efficiency gains of that next generation batch is even higher than what you had for your preferential early access to your batch. And so it's just a never-ending game as far as I see it. And then my problem here then is that a lot of these companies do not seem to be paying enough prudent attention to their return on capital. And that is weird to me.
Yeah, it is weird. Let's talk about that. I actually kind of want to end the podcast on that note. We could probably spend a decent amount of time on this. There's a lot of PubCos out there who have had huge ATMs over the last 12 to 24 months to finance their operations. And they can just pull the trigger on them because they already have them in line with SEC. They have the ability to do this. They go out, print it to market. The pro side of the argument would say, we did this much in ATM and now our market cap is 4x, 5x higher. Right. So we have return investor capital. The con side would say, look at how much money you've actually made. And is it worth the ATM there? And we should also mention that just because your market cap at a certain moment is pretty large doesn't mean that every investor has ROI'd well on that purchase. Right. Because you can purchase low and sell high, or you can do the opposite. How do you kind of square these things? How do you kind of square these two arguments for using ATMs to go and make these large purchase orders?
Yeah, I think it's just frankly an issue of oil and water not mixing, because here we are in the Bitcoin sphere. needing to operate basically on a Bitcoin standard. Because if you are a mining company, then you are on the Bitcoin standard, whether you want it or not. But of course, they have a foot in the fiat world. And so a lot of them are incentivized to, quote unquote, play fiat games. And it's not like dunking on them or anything. That's just like how the world is. And that's the world that they kind of need to operate on because they're bound by rules, and their executives are law bound to do certain things. And so at the end of the day, like the way that I look at it is that if you're an investor in a mining company, you're basically looking at something that is an extra. It's like an additional beta play on Bitcoin. So you have additional volatility, the potential for outsized returns. And so at the end of the day, then if you're a mining company, if you're not outperforming Bitcoin over time, and I can stomach that volatility, and I think a lot of investors are kind of okay with that. We can take the volatility of like the double movements or whatever, but, don't come here and dilute my position and then go and underperform Bitcoin and say that you delivered like great ROI for the investors. I mean, yeah, that's kind of true in fiat terms, but my opportunity cost, and I think a lot of investors that are investing in mining companies are themselves on a Bitcoin standard, right? Like I look at my own capital. This is like me personally. Yeah. And if you're not going to outperform Bitcoin, then I'm not really interested unless you bring me a lot lower volatility. And that's not what's happening. So I think it is probably like a transition period thing where through a lot of no fault of their own, they're kind of just stuck in between two worlds. And one world is tugging them really hard in a way that, it's the Bitcoin steamroller. Like it's just going to do what it's going to do. And you either are with it or you're not. And then the other world is the fiat world, to which, they're legal companies with fiduciary responsibilities and all of this stuff. It could be an impossible trade-off sometimes. So there are an increasing amount of mining companies that have started changing their kind of tune on this, where that they'll basically agree to the fact that if you're a mining company and you're not outperforming Bitcoin, then what are you even doing? Like you're wasting capital. Then like you're not profitable as far as I'm concerned, because if you can't mine a Bitcoin for less than a cost of a Bitcoin, then you should just you should take the investor's money and go buy Bitcoin with it, right?
Yeah.
Like that's that's arguably even lower risk. Like it's not a materially different risk spectrum that you're operating on. If Bitcoin goes to zero, you're going to zero, basically. I mean, you'll have your like data center residuals or whatever, but with, a huge part of your capital stack tied up in ASICs would literally have no other use than mining Bitcoin, unless we're all going to get like really cool, like custom hashes or whatnot, no one's going to pay for that.
Everyone gets their own custom hash.
Interested in Bitcoin scaling, startups, or learning more about Bitcoin softworks? Join us Saturday, November 9th at the Fidelity Center in Boston, Massachusetts for Op Next, a one-day conference on scaling Bitcoin hosted by Blockspace Media, the producers of this podcast. Join Bitcoiners like Peter Todd, Portland Hodl, and more to discuss various Bitcoin proposals like OpCat, the Great Script Restoration, CTV, and more. Attend workshops, speaker sessions, and panels discussing the latest in scaling tech, from ZK to ARC to Bitcoin softwork history. And for a limited time, use code OCTOBER to get 25% off a general admission ticket. Find out more by visiting opnext.dev. Again, that's October at opnext.dev. You can find out more by checking out the show notes below.
Are there any structures you've seen for financing Bitcoin mining companies that have been interesting to you? And I'll bring up two examples that come to my mind. One would be Cormint, which does like this debt offering where you give them a Bitcoin and there's a promissory note and you get 1.3 Bitcoin back in the future. And I'm making these numbers up. That's a pretty cool model.
Yep.
And then obviously the antithesis to that is the ATM model where we go to the public market, raise a bunch of money and like hope that everyone comes out on the other side making a bunch of money. Both allow you to finance large orders of both ASICs and power contracts. So that's necessary to run a Bitcoin mine. But obviously the outcome is a little bit different. They're both uncertain, to be sure. But any other models that you like, or do you like either of those models resonate with you with just some changes?
Well, I mean, selling hash price forward is another budding thing. But so I mean, I am an investor in the Cormint bond offering myself.
Oh, nice.
I actually found that really interesting, and part of what intrigued me. And I've been following the Cormint team for a long time, and I find them very impressive in general. But they have from day one always talked in terms of, give me a Bitcoin and I'll make 1.5 Bitcoin, right? Like that is the way that you got to think about this, in my opinion. And so if you're not doing that, then I have reduced confidence that the long-term business model is going to work out. I also think Cormint sit low enough in the cost curve of the industry in general that they do get that kind of cushioning against difficulty rises and hash price drawdowns, because other people are going to be forced out before them. But I think that financing model is very interesting. It's like at the same time, it is expensive, right? It's expensive, and unless you are that deep in the cost curve, because you're going short Bitcoin, right? And then you got to be really confident that, with your ASICs, you're going to recoup that. But pricing ASICs in Bitcoin terms, I think is the way to go. And so if you're pricing your ASICs in Bitcoin terms, there is a Bitcoin price for which it makes sense, and you're getting like a certain Bitcoin return. And from that, you can calculate what kind of debt load you can tolerate. So I think it's very interesting. I think Bitcoin bonds to miners is like one of the few areas where that makes any sense whatsoever, because you can actually create new coins. Don't come at me for whether that is like technically whatever, but you know what I mean, right? Like you have new coins added to the supply, and so you can actually pay an interest on a Bitcoin balance without there being like a zero-sum game involved. And I think that's quite interesting. Now, going to fiat capital markets and getting money, there's nothing intrinsically wrong with that. My question is just like how long are investors going to tolerate that type of dilution when I mean a lot of investors in mining companies may not have come to the realization yet that their opportunity cost is Bitcoin. And so they look at it and they're like, oh, I'm making a ton of money, like I'm outperforming my, fiat cost of capital by a lot. This is great, right? But the realization just hasn't struck them that like actually Bitcoin has the same exact risk profile and lower vol. And so if the company is not outperforming that, then you're making a bad investment decision, in my humble opinion. And then, finally, if we can get a deepening of markets where miners would be able to hedge at certain hash price levels, I think that could be a good way to finance operations as well. More akin to like traditional commodity setups where you can kind of lock in a certain margin based on the overall inputs of your business. Otherwise, you can hedge your electricity cost. Then if you can hedge your hash price, it just starts looking more like an oil field, right? Which can sell forward a set amount of quantity of oil, right? And Bitcoin miners obviously can't do that because of the difficulty. You don't know how many Bitcoin you're going to get out of your mine, right?
Yeah.
So derivatives are an exciting new area, but obviously like getting the network effect created in those markets and getting the market depth to be where it needs to be for it to be actually useful at scale for miners is a challenge. And I know people have been working on this literally for 5 years now. But it's getting somewhere, right?
Yeah.
It's taking a long time.
One last question. What do you think about the sats per share thing that kind of has popped up recently with Cathedra and others think about like their Bitcoin hodl overall?
Well, I mean, Saylor has been getting increased amounts of sats per share over time. I think that's very interesting, and that in itself, if done in a sustainable way,
There's some reservations about that, huh?
Let's not go there. Who knows? If that's done in like a consistent way, let's call it that, consistent way.
Okay.
Then I think that's a reasonable. That's an acceptable reason for why a premium might want to start building on the NAV of the Bitcoin hodl in those shares. I think this is quite clever, and I that is another thing that I like to see. It's another nice thing for an equity holder is to have an actually increasing amount of coins per share. So I like that. I think achieving it is going to be non-trivial, but it seems doable. And if people can pull it off, I am so for it. I mean, that it makes equity a lot more enticing versus Bitcoin, right? If you have, it's basically like getting a yield on your Bitcoin for some risk. So you trade the risk for some yield. I mean, it's a story as old as capitalism.
As old as time.
Yeah.
With both winners and losers. Okay, well, that kind of like summarizes all the questions that popped into mind from my reading of the article. Anything else that you think we should go over before we close out here?
No, I would impel a caution among investors and like reading a little deeper into these things.
Yeah.
It's easy to get kind of lost in the forest of different metrics that various companies put out, and keeping your like eyes straight on like whether everyone is actually making positive return on their ASIC investments, and then at the end of the day, like, are they outperforming Bitcoin? I mean, that's just how I view it. That's how you got to approach this. I think equity investors have been very forgiving for a lot of these companies, maybe too forgiving. And I don't know if that's always going to be the case. And so, beware sentiment shift there. And, let's make miners outperform Bitcoin again.
You should make a hat for that. Chris, thanks for joining the show. As always, good to see you again. And I'm sure we'll talk here soon.
Thank you for having me.